Good day, Doctor. We are from Group 4, and my name is Tung Yu, matrix number 277548. And today I will represent my group to present about the group assignment. First, we have determined three objectives in this group assignment. The first objective is to examine the viability of the company's strategic plans, and the second objective is to estimate the degree of impact on share price after the point at which return on equity is equal to cost of equity capital based on the forecast. Lastly, valuing the equity of the company, which is SC Estate Uterberhard, will be the third objective. The objectives are important because we can estimate the company performance, whether they will be able to generate sufficient cash flows from the operations to finance expected growth, or will be required to seek debt or equity financing in the future. Furthermore, we are also interested in analyzing whether current strategic plans will yield the benefits forecasted by the company management. In order to achieve these three objectives, we have come up with prospective analysis. Prospective analysis is the forecasting of the future financial information. So for years 2019 to 2021 are the past performances of the company, which we attracted to present the information into two tables. While 2022 is the period of time in which the prospective analysis starts. And the interval between years 2022 to 2026 are integrated together with the past, present, and future information. The techniques we use in prospective analysis are financial statement forecasting and valuation. There are two stages of prospective analysis, which are long-term forecasting, referring to the analysis of past data and forecasting of financial statements, and implementation, which refers to the use of forecasts to accomplish the objective. The importance of carrying out this prospective analysis are security valuation, assessment of solvency, management and assessment, and lastly, prediction of future performance. Prospective analysis is useful to creditors to assess a company's ability to meet its debt service requirements. In this case, prospective analysis is helpful for us to determine residual income, which defines the company's equity value at specific time as the sum of current book value and the present value of all future expected residual income. We properly adjusted the historical financial statements to accurately reflect the economic performance of the company. Moving on, what we have done first is we performed the recent 3 years financial statements of SC Estate Uterberhard in two tables, which are balance sheet and income statement, respectively from 2019 to 2021. This historical data is helpful for us to determine these ratios, namely sales growth, net profit margin, net working capital turnover, fixed asset turnover, financial leverage, and number of shares outstanding, which will be used for prospective analysis in value securities. Hence, these ratios are performed in a table in percentage form and amount for year 2 and year 3. Next, by using the capital asset pricing model, or its abbreviation CAPM, we calculated the cost of equity capital of 10.5% with the information given, which are risk-free rate of 3%, expected market rate of return, which is 8%, and the beta of the stock, which is 1.5. Afterwards, from the computation of these ratios, we came out with the forecasted income statement and forecasted balance sheet. In this group assignment, we used historical trends to predict future levels. A more detailed analysis would incorporate with outside information, such as the expected level of macroeconomic activity, the competitive landscape, and new versus old store mix. We begin with an assumption that revenue will grow at 10% in year 2022, and with assumptions the steps in the projection of forecast income statement, followed by gross profit margin, operating and administration expenses, and taxes on earnings or earnings before taxes. On the other hand, the selected ratios and steps involved in the projection of forecasted balance sheets are accounts receivable turnover, accounts payable turnover, accruals turnover, tax payable or tax expense, financial leverage, dividends paid per share, capital expenditures or sales, and lastly, depreciation expense. Sensitivity analysis highlights which assumptions have the greatest impact on financial results and consequently help to identify those areas requiring greater security. Subsequently, by assuming sales growth of 10% each year over the 5-year forecast horizon and sales growth with long-run inflation rate of 3.5% after 5-year forecast, which is in the terminal year, we prepared a valuation of the common stock of SC Estate Builder Berhad from year 2022 to 2026 with terminal year of 2027. The valuation process requires estimates of future net income and the book value of stockholders' equity. In this relatively simple form, the valuation model requires estimates of 6 parameters, which are sales growth, net profit margin, net working capital turnover, fixed asset turnover, financial leverage, and cost of equity capital. Afterwards, we apply prospective analysis in the residual income valuation model. The residual income projected in 2027 is assumed to grow at the rate of inflation, which is 3.5%. Therefore, the present value of this annuity is discounted to year 2021. The formula and working for the residual income computation are shown in the report. Valuation of equity shares is critically dependent on the projection process. As discussed above, our valuation should closely examine the sensitivity of share price estimates to underlying assumptions in the projections. Lastly, based on our forecast, the degree of impact on share price after the point at which return on equity is equal to the cost of equity capital is shown with evidence. At year 2024, when the return on equity ROE is equal to the cost of equity capital K, which is 10.5%, by applying the formula of residual income model, the residual income achieves 0 at the year. Hence, it is proof that the stock price is only impacted when return on equity is not equal to the cost of equity capital. In equilibrium, competitive forces will tend to drive rates of return on equity to cost of equity capital so that abnormal profits are competed away. When dividing net income of last forecasted year with the balance from value of equity and beginning book value of equity, we will get the return of equity of 0.1082%, which is far different from the cost of capital, which is 10.5%. Thus, we can conclude that there is a huge impact on the share price where cost of capital is far higher from the return of equity. In conclusion, the degree of impact on share price will have little impact or remain constant after the point at which the return on equity ROE is equal to the cost of equity capital. In this case, return of equity is far different from the cost of capital, showing that management is destroying value, which the company is becoming less efficient at creating profits and increasing shareholders' value. To summarize, the three objectives have been achieved. From the return on equity computed from the valuation of the common stock of SC Estate Builder Berhad, which is less than the cost of capital tremendously, shows that the strategic plans of the company did not work well and are less efficient in using equity capital to increase shareholders' value.